the fight against COVID-19 in the National Capital Region and through Nanavati in Mumbai. We have already treated over 21,000 COVID-19 patients at our hospitals. In addition, 2,000 patients at their homes and conducted over 3.2 lakh RT-PCR tests already. Our teams continue to focus on clinical excellence, and I am proud of the achievements of our doctors and support staff. During the course of the pandemic and over the last quarter alone, our doctors have published over 85 national and international publications, with top 3 being from oncology, nephrology, and urology departments. We have conducted 30 studies and trials on COVID-19 indications and 45 non-COVID-19 clinical trials across the network. Most importantly, we continue to serve patients from the economically weaker sections of the society. In the past quarter alone, we have treated over 900 inpatients and 26,000 OPD patients free of charge. Now coming to the financials. We are pleased with the results, which from our perspective are on expected lines. This has been a growth quarter as indicated by us in our previous call. As you would be aware, COVID is a challenging time as a large number of beds which otherwise would be utilized for higher ARPOB business are blocked for COVID, which is a relatively low ARPOB business. Elective surgeries are typically pushed out and medical tourism has been slow. As you would recall, for the months of October and November, COVID cases in Delhi were severe and peaked. In November, upon peaking of these cases, the government actually reserved more beds for COVID. While this occupancy dipped, COVID occupancy dipped in December, there was a lag in these beds being de-reserved. This is a period where we had higher occupancy but lower ARPOB, and as COVID cases began reducing in December, our occupancy reduced but our ARPOB increased. The occupancy reduction was primarily driven by unutilized beds reserved for COVID, as well as disruption on the roads leading to Delhi due to farmers' agitation. However, absolute EBITDA and margins for December were higher than October and November despite lower occupancies. This gives us the confidence that as things begin to normalize and elective surgeries and medical tourism starts coming back, we would expect to see higher occupancy along with ARPOBs. At present, our international business has grown 2 to 3 times over the previous quarter and now stands at almost 50% of pre-COVID levels. Moreover, our OPD footfalls continue to be 65 to 70% of pre-COVID levels, which we expect to normalize over the next few months. Further improvement towards higher surgical mix upon reduction of COVID should also provide impetus to our ARPOB. Despite COVID challenges, gross revenue for the quarter stood at rupees 1,160 crores, a growth of 6% year-on-year and 24% quarter-on-quarter. We have hit EBITDA of rupees 252 crores for the quarter, a jump of 58% year-on-year and 75% quarter-on-quarter. Moreover, over the course of this quarter, we have restored all our transient and temporary cost and salary reductions. During the quarter, in addition to payment of rupees 38 crores of stamp duty for merger, we have reduced net debt through internal accruals by additional 121 crores, which now stands at 1,867 crores, including any and all put options as of 31st of December. Our record performance is reflective of the structural cost savings we have implemented, post-merger synergies being executed, as well as growth in our tower specialties. While we have been battling COVID for all of this year, we have also parallelly been laying ground for immense growth in years to come. Whether by way of building clinical programs, we have added more than 30 senior clinicians and teams over this quarter itself. Our digital platform and asset-light adjacencies. A closer analysis of our revenue will lead you to that inference as well. Going forward, we plan to focus on improving utilization and existing facilities, optimizing these ARPOB, brownfield expansion on existing land banks, scaling up our capital-light adjacencies like Max Lab and Max at Home as well, and opportunistically looking at M&A opportunities. We would also commence our brownfield projects and construction in the beginning of FY22 itself, in the first quarter. Overall, I'm pleased with what the team has been able to achieve in a seasonally weak quarter under difficult times. We are cautiously optimistic on the growth path ahead. On this note, I wish to now open it up to any and every question that you may have. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, congratulations on a great quarter, sir. Just 2 questions. One, let's say from next year onwards, from quarter 1, let's just an assumption there is no COVID patients at all in the hospitals in your network. We are doing almost 250 crore EBITDA right now, so then ideally we should be doing like next year 1200 crore kind of EBITDA, or is that not possible? Just trying to understand this 250 crore based on your commentary sounds only a subdued number because you had the COVID patients in this quarter.
As been in the past, I'm going to stay away from any forward-looking projections. But if you look at our numbers, even in quarter 2 of the current year, while our revenue was lower by 18%, okay, and this quarter it's actually grown by 6%. Whilst our revenue in the last quarter itself was lower by 18%, we had still done about a 16.2% EBITDA margin. If you do the math, you'll see that pretty much the landing point would have been here if we had done and had grown as the way we have. But I think other than that, what you've also seen is that occupancy levels, like I mentioned, in the month of December had come down because a larger amount of beds were booked for COVID, whilst the COVID occupancy had reduced. But even in this month, where the occupancy was lower than October and November, we had come down to about 70-71% in December. We hit record EBITDA levels. So you have to assume some sort of a growth. If you are assuming any growth or degrowth, I don't know next year. But you can kind of extrapolate this.
So that's exactly what my question was. All the commentary seemed to suggest that this quarter would have been much better if COVID patients were not there. Then we doing 250 crores, then ideally on an annual basis we should be doing at least more than 1,000 crores. I'm not asking a projection. I'm just trying. You please understand what the question I'm trying to ask is there any one-off in the quarter that you want to mention, or this 1,000 crore plus run rate is very much possible now?
No, we would have had about 10 odd crores of transient cost cuts through the quarter, like I said, which we've restored entirely now. So it's not going to be carrying forward to the next quarter. COVID patients earn us less ARPOB and less contribution compared to non-COVID patients. That's also a statement of facts.
And how much would have been the EBITDA from the COVID patient this quarter if you were to just split up this 250 crore in 2 parts, COVID and non-COVID?
So we can't really measure the EBITDA at that level. But what Abhay mentioned is that the COVID patient is less ARPOB. So while we had 19-20% of the revenues in the quarter coming from COVID patients, but also as Abhay mentioned earlier that we will have the occupancy coming down because the occupancy were at a 76% level in the quarter 3. So some occupancy, level will come down with the COVID going out, but at the same time, the patients which will come in to replace those COVID patients will be higher ARPOB patients, so which will be able to compensate for that lower, occupancy with the higher ARPOB. So on an overall basis, we think this is in a way a sustainable performance.
Sure. Thank you.
Thank you. The next question is from the line of Alap Mahadevia from Briarwood. Please go ahead.
Yes, hi there. How are you? I just had a question on. No, thank you. And congrats on the quarter. Just you were talking obviously about kind of the quarter having two parts, kind of when COVID was much more prevalent in Delhi, and then in December, and about the profitability being higher in December. Can you, given it's historical versus forward-looking, can you quantify a little bit maybe what the margin was in December, or just kind of how much higher EBITDA was in December than maybe earlier in the quarter? I know it's only a month, but it could give a better sense for more kind of the run rate going forward as COVID normalizes.
So, Alap, I'm going to stay away from giving you specific numbers, but I can tell you within the quarter, the lowest occupancy in the quarter was in December. Occupancy numbers I can give you was about little short of 71% for the month of December, which was lower than October and November by about 5 or 6 percentage points. But the highest revenue, highest ARPOB, and the highest EBITDA that we had was in December compared to October and November. So I hope that's helpful.
Yeah, it is. Thank you.
Thank you. The next question is from the line of Raghav Kapoor from Active Alpha. Please go ahead.
Hi, Abhay. This is Raghav here. My question stems around the cost-saving incentive plan that was in place, where a payout of equal to 140 crores or so was planned or is planned to be paid to yourself or some of the senior management members. Just wondering if that is something that has been implemented so far. Why such a large payout for what appears to be kind of the management's job to reduce costs and improve profitability, and if that's going to be repeated again in the future?
So there's no payment which the company has made to me or was intending to make to me. There was a pre-merger understanding between KKR and myself, where upon certain distinct, KKR was to transfer 1.5% of the shareholding from their own shareholding to me. So that is something which we discussed, but this is an inter shareholder arrangement. The company, although is a party to it, is a confirming party to the arrangement, but it is not anything on account of the company at all.
Okay, great to hear that. Thanks.
Thank you. The next question is from the line of Damayanti Kerai from HSBC Securities and Capital Markets. Please go ahead.
Hi, congrats on a great set of numbers. My question is regarding occupancy. So December, obviously you mentioned it was a low quarter, but on a normalized basis also we are much on the higher side compared to some of your peers. So how much occupancy you can achieve in your mature bed in normal state? Say there is no COVID case anymore.
So if you actually see, traditionally also we've been 6 to 7% higher, through the entire pandemic and even pre-pandemic compared to our competitors. Pre-pandemic, our occupancy levels were 72, 73%, which went up to late 70s or closer to 80 and plus during the COVID. And even in the down quarters of COVID, throughout, while there's been at least a 10 percentage point difference between our occupancy level and others. This is also, some part of it I'd like to believe is due to our efforts, but a large part of it also may be due to the fact that a large part of our, or 85% of our portfolio is in the metros of Delhi and Bombay, which has higher amount of affordability, more dense population, and so on, which allows that.
Sure, that's helpful. And my following question is on ARPOB. So again, you are best placed among many of your peers in terms of metro presence or the kind of speciality you offer among the high-paying patient. So, say third quarter ARPOB of around 51,000. See, like going forward, what will be the level which you are targeting? Say next 3 to 5 years, and what will be key drivers for it?
So our higher ARPOB doesn't come by virtue of catering to more affluent population. It comes by virtue of higher end clinical programs. We focus a lot more on, let's say, transplantation, solid organ transplants, on oncology, on cardiac sciences, on neuro, and so on and so forth, which are high-end quaternary care procedures and less so of the lower-end quaternary care procedures, etc. We are not single specialty hospitals. Each one of our hospitals are multi-specialties and have the entire suite of services. So it's not as if a suite class, patient type suite class is perhaps where we have our lowest occupancy relative to anything else. But yeah, this has also allowed us because even pre-COVID levels for the past 2 or 3 years, we've been outperforming the market or have been significantly higher in terms of our ARPOBs because of this. And the prime reason for this is that we are able to host the high-end specialties because doctors who are imparting these clinical services, there is a huge shortfall of them across the country, but most of them do reside in cities of Delhi, Bombay, Bangalore, and so on. And the fact that we have a larger concentration in the metro allows us to be able to perform these services.
Sure. And my final question is on the talent side. So you just mentioned you have better reach to the specialized doctors. So how do you see competition scenario in terms of retention of medical talent, especially in metros like NCR?
So I think specifically in the metro of NCR, we are probably 2.5 times the size of the second largest competitor. We have about 4,000 to 5,000 senior clinicians on our rolls, which on a full-time basis, there are about 11,000 GPs which refer business to us. We just the size and scale of our sales teams, etc. The feet on the street are a lot more. So we are the preferred preferred place for most doctors to practice. At least as far as the high-end specialties are concerned. And the best way to retain somebody is to be able to ensure that his earnings increase year on year, and we're able to do that by increasing the overall size of the pie. So I think it's the doctors themselves grow because and they're less likely to move anywhere else because we are growing at a faster clip, like you pointed out, both in terms of occupancy as well as ARPOB.
Okay, just if I can squeeze in, how much of your operating cost is towards doctor payout? Say, how much is fixed?
So our cost usually is coming to about 15%. I think it was 14 point something in the last quarter on this quarter 3, but it's circa 15%.
So that's the fixed part of payout to doctors.
No, so there is a variable part into it. So what happens is that beyond the level, the doctor starts to get higher payout because of the when the notional payout is higher than the minimum guarantee. So there will be some portion which is variable in this.
But all in is 15%.
Yeah.
So 15 includes the variable and the fixed. Yeah.
Okay, that's helpful. Thank you for your response.
Yes.
Thank you. Next question is on the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead. Mr. Praveen Sahai, your line is in the talk mode. Please go ahead.
Yeah, thank you for taking my question. And many congratulations for your good set of numbers. The first question I just take on the last participants regarding ARPOB. So on the ARPOB, if I look at for the past quarter, the foreign patient contribution is still at the 4% level, which used to be at 10-11%. Even the COVID have some contribution. Even though we had reached 51,000, that's I can see that's the highest for the several quarters. So do you believe there is with these foreign patients, with the COVID going away from the system, these numbers to go up significantly from here?
That's right. So on 3 accounts, I think one which you pointed out, international business, which is right now at 50% of pre-COVID levels. Okay, once it comes back, that obviously is a higher ARPOB business. That's one. Secondly, with COVID and the ratio of COVID also going down, you're going to have a higher surgical mix. because you have a higher surgical mix, it also has a higher ARPOB. And thirdly, even OPDs, we are only at 65 to 70% of our pre-COVID OPD levels. And once this restores, you're going to see a higher jump in ARPOB. I mean, that's bound to happen when your OPDs restore to 100 because, OPDs by themselves get divided over the number of beds and increase the ARPOB.
So one clarification, sir, over here. Is there any, for the Q3, if I look at, is there any uptick or a pickup due to a selective or elective surgeries has come from a Q1 or a Q2 now to a Q3? That is the one of the reason for a high numbers in this quarter, or you see as a normal number?
Not really, because almost more than 1/3 of the total beds, were reserved for COVID. So even if you see on an overall level, if I look at overall COVID, we're not back to pre-COVID levels. It's just the number of beds, also the total capacity which is serving that has being lowered. That's why you're seeing a higher occupancy on COVID. So I don't frankly see any latent demand or something which has come into play right now. No.
I already mentioned that in December our occupancy was lower, but our EBITDA was higher, all right, for the month of December we're talking, as compared to other months.
And revenue.
Yeah, and revenue. So that obviously means that the ARPOB in December went up, which means that there is potential to, once the COVID comes down, the ARPOB should improve from where we are.
That's it.
So there is no element of elective surgery which has postponed in the first and the second quarter, has moved to in a third quarter. That's I just wanted to clarify that.
None. In fact, I would argue that certain departments like orthopedics, etc., have not come back entirely. I'm still way below what they're doing. So while some specialties have come back, some have not entirely, but some are below par even at present.
Yeah, so one element in the ARPOB that we've seen is that even in the non-COVID side, we are getting more serious work. All right, the ARR or the ticket size of the patient who are coming in for non-COVID has gone up. All right.
Mm-hmm. Okay. And
but nevertheless, it's still far below our non-COVID ARPOBs. It's still a drag for us.
Great, sir. Sir, secondly, on the COVID beds, is there a restriction is easing out to reserve beds for the COVID from the government?
Yeah. So interestingly, when it peaked in November, the government increased the restrictions, right? So we had to actually, whilst our non-COVID beds were totally full, we still had to kind of empty those beds out and put it for COVID duty, the non-COVID beds. On the 10th of January, the restriction has come down to half of what the commitment was. So it's been reduced, and we believe it will be further reduced. So there's been a de-reservation of those beds since.
So right now it's a 1/3 or it's lower than that?
No, it's lower than that. It's about 15%, 15 to 18% of the beds would be reserved.
Okay, great, sir. Thank you and all the best.
Okay. Sorry, yeah.
Thank you. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Thanks for taking my question. Sir, if I understand correctly, you're pushing your brownfield expansion forward. In the sense, you're preponing it by a couple of quarters. So earlier we were to see beds coming online in FY24-25. What would be the revised timeline from that?
No, so look, actually this expansion was supposed to begin in June of the current year. We had postponed it due to COVID. And we had said, look, once we get certainty, we are going to begin breaking ground on this because most of the approvals, everything is done. We are yet going to do that in very early beginning of FY22. And we still expect about 3.5 years of construction time on this. Having said that, I've also said in the past that we do a large amount of institutional business. 35% of our beds were catering to institutional business, which is at a 40% discount. This is contribution positive but EBITDA negative business. We successfully, and I said we will be moving away from this So from 35%, we brought it down to about 31% right now. So that's what we are going to be doing is, by the time this new capacity comes on stream, over the next 3 years, 4 years, we will be reducing our dependency, or we'll reduce catering to the institutional business and repurpose or provide normal cash business or normal business that we do on these beds.
If I understand correctly, even on the same occupancy levels, your margins can continue to go up as the institutional business keeps coming down.
That's true. So two things. One is, our pre-COVID level occupancy levels were 70 to 73%. During COVID, we demonstrated also overall network occupancy of about 80% plus. We are back down to about 70-71% in December. So we have headroom to go up to 80%. But more so within this present this thing, we have an ability to stop doing institutional business and cater towards more or an opportunity to stop doing institutional and move more towards the cash business, which is at a 40% premium, so to say, to this business. So yes, within the same capacity also, we can have higher revenues. While our cost structure remains the same. That's more important.
Right. The second question that I had was on the opportunistic M&A comment that you made. What kind of assets are you looking at, and how will you fund any such activity?
Sorry?
M&A opportunity and how do you fund it?
So I think, from our current run rate, our debt to EBITDA is less than 2. That's one. Secondly, to comply with MPS requirements, we had suggested previously also and have taken approval for a QIP. We will have to issue, we are looking to issue, be in compliance of that, and by doing that, that should be able to raise us another 11 to 1200 crores, which we will be doing. We have obligated to do it before August. So it will be in the near future. And so I think those funds will be all available. And on top of that, I think we had mentioned we are generating cash month on month, 40 to 50 crores of excess free cash flows, which right now we are using to pay down debt. We pay down our amort over the next 2.5 years, in fact. We don't have any payments coming up. And so all of that is going to be helpful in creating a war chest for us to do M&As.
And what kind of assets would you be looking at?
Well, we'll be looking at either metro-centric or assets in proven locations. We're not looking at any greenfield, so to say. Essentially there would be a certain size and critical mass, certain size and scale. If it's metro-based where we are not present, it would be something which would be at least 400 to 500 beds. But if it is in, let's say, Delhi NCR, we are happy to even look at 250 to 300 bed hospitals.
Thanks. Thank you.
Thank you. The next question is from the line of Gitika Gupta from First Voyager Advisors. Please go ahead.
Hi Abhay, a great set of numbers. I have just one question. What are the long-term structural changes in the industry that you're seeing because of COVID?
I think plenty, and all seem very positive. Let me start from a revenue standpoint. I think first and foremost, if I look at global medical tourism, I think India will definitely get a much larger share of the pie going forward, simply because, the oil economies, for example, which have been big purchasers of global medical tourism for their populace, they are balance sheets under stress. They've started, incurring, imputing taxes in their own countries, and they will be searching for value as well. And which better place that provides you value for money as far as medical matters are concerned and tourism is concerned than India. So that's one. I think as far as cash paying patients are concerned, insurance, there's a huge proliferation of insurance during the pandemic. I think clearly that is something which is going to augur very well for the organized sector, particularly, because when people have to pay from their own pocket, they are conscious about and very sensitive, price sensitive. They may go to a smaller nursing home, but when you're looking at when the insurance company is paying, you go to the best that the insurance company is empaneled with. From that standpoint, it is going to be helpful. And we've seen in the past, as insurance has proliferated, it's been to the benefit of the organized sector. So I think that's the second thing. The third is, if you see this budget as well, there is the government, although not much for the private sector, but clearly I think they have spoken about setting up capacities and infrastructure in primary and secondary, and these are typically feeders for us. Primary healthcare, secondary healthcare are feeders for quaternary healthcare. They're looking at setting up testing centers and so on. These again become early markers for diseases for us, and they become funnels for us. If you look at digital health, again, it's something which has been spreading like fire. What that basically means is that you can reach more people more efficiently and more cost effectively. Essentially, it's like taking your OPD to more people. The more people you have a particular conversion rate. The further you cast your net, the more conversions you're going to have. Unfortunately, what you can't do is do surgeries over video consults. Again, this is something which funnels business to us. I think these are important things. Other than that, if I look at from a cost structure standpoint, I think not only the healthcare sector, but most industries have become used to frugal living and do more with less. So I think, all of this should, and particularly let me tell you, from a healthcare sector standpoint, what we faced over navigating the ship during the whole pandemic, with the level of uncertainties, very few industries get an opportunity to be exposed to this sort of stuff. I think, so from a management standpoint, it's really, it's seasoned everybody quite a bit.
Great. Thanks for the detailed answer. When you mention digital health and maybe the opportunity to reach higher number of people, do you think some of these trends would this trend be sticky? Do you see people still continuing using digital channels to access OPD? And the other question is on government. The government regulatory environment has been a little, unfavorable over the last few years prior to pandemic, with the kind of price caps that we saw on medical devices. Do you see, some of that reversing now, given that the government is likely to have a more favorable view of the healthcare segment? That's it from my side. Yeah.
So see, look, from my standpoint, the government push has always been towards transparency and less towards, the caps is also a measure of transparency. The fact is, somewhere across the industry, if some of the, let's say, the independence people had was also being kind of misused in the country, doctors may have been induced to support certain medicines, etc., etc. So I think by putting these price caps, what you've done is the government reduced, the ability to market these sort of things. So I think it's been a push towards transparency. Having said that, so I don't think the push towards transparency will reduce. I think as we go along, in fact, in the economic survey, there was also a mention of an ombudsman, of a regulator for this thing, and all of that is a push towards transparency, which will be at the cost of the disorganized sector. I may add on to this. But having said that, I think there is also a huge let's say, acceptance of the fact that there is a need for medical infrastructure, and the private sector has done a great job during this, because the government infrastructure wasn't really able to keep up with the pandemic. And not only, I think, every state, but I think every country in the world will be sort of seeking these dollars with the capital to be able to set up this infrastructure. Certainly India is one of them. So I think, from that standpoint, there will be encouragement rather than discouragement, and some of these knee-jerk reactions at least will be more thought through.
Okay. Great. Thanks. Thanks for the answer. That's it from my side.
Thank you.
Thank you. The next question is from the line of Shaleen Kumar from UBS. Please go ahead.
Yeah. Thank you so much, and congratulations on the good set of numbers. I have a bunch of questions. So regarding, I missed your earlier remark, in case you have already clarified this, that 320 crores of cost efficiencies that we have identified. So is it all baked in, or there is something more to come?
So 220 crores is something we did in the previous year. All of it was implemented. In the current year, we said we will be doing 100 crores of further cost savings. We've done pretty much most of it. 80 to 85 crores we already completed. Of that, balance 10-15 will get completed through the course of the year. Most of it, if not all of it, is already being banked in the current run rate that you're seeing.
Current run rate. Okay. Sure. Okay. And now, if I look at your payer profile, for let's say this quarter, so obviously your international has gone down. Self-pay has also gone down a bit, but your TP and corporate have improved significantly. Anything that you guys are doing? What's driving it?
So I think clearly international has gone down. The other which has gone down is institutional.
Yeah. Agree with you. So all of it, which is interesting, that the TP and corporate has expanded. So market, the shift is towards TP and corporate. So is there something which you're doing that we should know?
No, so I think a lot of the COVID patients were insured patients and corporate patients, etc. So because of the medical management and these patients really being from Delhi, NCR and so on and so forth, we had a higher, and we were the preferred centers for COVID. If you're from Bombay, you'd recognize that Nanavati was the place to go, but if somebody from Delhi on this call, then Max has been at the forefront of COVID and been the preferred place for people to go for COVID. So we've had a larger, we've attracted a lot more TP and corporates for that. From the higher amount of medical management.
I think this is a phenomenon that you see all over because the penetration of insurance has gone up during the COVID times. There are special insurance policies which are sold. I was talking to my Lupa team and they said in the month of April they sold what they sell generally in 4 months. In terms of number of policies. So the penetration has gone up, and that penetration obviously means that there will be more insurance patients which will go into the hospitals.
So once COVID subsided, what kind of pie should we expect? Like institution. So let's say international will come back in a year or so. So the shrink will be from TP and corporate, or because it was largely COVID patient, or the shrink will be from your institution. And
So structurally, I think structurally we are moving towards a shift towards institutions. Okay, reduction of institutions, like I said, because that's the business which is at the maximum under discount, right?
Yes.
To other patients. Other patients pay us 100, the institutional patient pays us 60. But having said that, we have to also play tactically. Strategically, that's the direction we're going. But if we see, there's a shortfall in demand in a particular thing, we just kind of open the tap a little more. But the direction we are going in over the next few quarters, you're going to see reduction in institutional certainly.
Right. No, I agree with you.
So there's no reason to believe that international will come and displace cash business. It doesn't work like that.
Absolutely. No, absolutely, I agree with you. So my point was that this TP and corporate, how much is it sticky? So that's the only thing which I was trying to understand.
I would say some of it will come down because once COVID patients come down, that will come down. So we've seen that happening also in the month of January. So some bit will come down, and also once the overall pie increases, then the share of everybody else will also come down now because the international patient come up.
Yeah, but I would not look at PPA separate from cash. And we have something called CTI, which means cash, PPA, and international patients. This is what we call a preferred group, right?
Correct.
So look at this as one homogeneous group moving up or down, because one at the cost of the other doesn't really matter to us.
Okay. So basically, your institution will not go up.
That's right. So institutions will structurally come down over a quarter or a month if we want to take it up, because there's a shortfall of perhaps when we are going to make this transition when COVID goes away entirely and so on. We can take that call, but that's more tactical calls. But directionally, you're going to reduce the business.
Understood. Also, in the specialty profile, I can see that your pulmonology and internal medicine has gone up significantly. So it's largely COVID-driven or something else again here?
Yes. So all COVID patients get booked under pulmonology as well as under internal medicine. But having said that, during this course, what has grown up the fastest are our tower specialties. Okay, whilst in this quarter we've grown 6% year on year. Our oncology business, our neuro and our cardiac has grown by 12%. So double our growth has been in our tower specialties year on year.
Understood. Right. And you already made a remark, that orthopedic has not come back because it used to be 10%. It's 5.7%, right? So there is a likely pent-up demand as well. Is it fair to assume that we can see some pent-up demand and orthopedic can grow faster as the COVID subsides?
Yeah, that's right.
Right. So, okay, last bit, on the answer to the previous participant which you make and on the digital economy, digital healthcare, and kind of agree with you that, and in fact, that's a personal belief that hospitals are least likely get disrupted, but these digital platforms can act as a funnel for them. But that's largely not your core, right? So do you think when you think of M&As or partnership, you think of doing something with healthcare platforms? Are you open to that, or are you considering that?
So I'll tell you, it's not core to what we do, but it's definitely core to our marketing and how we fill our beds. So one of the key things that we look at is OPD footfalls, because there's a direct correlation between OPD footfalls and IPD conversions.
Right.
So what we do work on, as much as we work on conversion from OPD to IPD, we also work on increasing footfalls of OPDs. So lots of hospitals all the time you'll see will have general OPDs, which are free OPDs, or we'll have camps. We'll run camps, diabetes camps, so on and so forth. The rationale behind running these camps is what? That you are able to test more people and you're able to identify potential people for IPDs.
Okay.
Right? Okay, so the minute I can extend this, without physical constraint of a space, to many more people, I'm only likely to get more and more people as far as conversion is concerned. So this becomes a very important part, of our reach. But having said that, there's some large players out there, whether it's Amazon, Jio, etc., who will be in this space. So it makes eminent sense for us to tie up with them as well.
Correct.
I mean, it will be intrinsic part of our service. But having said that, I don't intend to compete against the Jios and the Amazons of the world.
That's the whole thing I was asking, because I am not debating on that, but absolutely there's one thing which is your strength, and there's something which probably strength of Amazon or something like PharmEasy or Practo, and probably a partnership could be a win-win. So you think that it makes sense? Some kind of
our investors, we ourselves don't have an appetite for that sort of game. They are playing an all-for-nothing game. We can't put $300 million or $500 million in something not knowing whether we'll even break even. So it's a different ball game, and we'd rather be partnering rather than competing in that space.
Understood. Great. Thank you so much. That's it from my side. All the best, guys.
Thanks.
Thank you. The next question is from the line of Ashwin from Akash Ganga Investments Private Limited. Please go ahead.
Good afternoon. Many congratulations to Mr. Abhay and his team for absolutely blockbuster quarter in very challenging times. So the inference I got from your opening comments was that October, November was high on COVID and December was much better, although the revenues were lower. But December month helped you get an idea of the EBITDA margins going forward. So can we expect next quarter, that is quarter 4, to be higher on revenue as well as a higher EBITDA margins? And what can be the color for next year in terms of EBITDA margins, if you can please add some thoughts?
I'm just going to correct you on your inference from my statements. Occupancy was lower in December compared to October and November.
Exactly.
But ARPOB
but the revenues were higher.
Revenues were higher, and so was the EBITDA the highest.
Yes.
Okay. So going forward, I'm not going to make any forward-looking statements in terms of numbers. But I can tell you, our international business is only back to 50% as yet. Our OPD is only back to 65 to 70%. Our surgical business will improve, and therefore, we have other things to look forward to. So no reason for my ARPOB to go down.
Okay.
I mean, both my ARPOB and occupancy theoretically should go up, because even with the farmers' agitation, as you can imagine, roads leading up to Delhi, there's been disruption. People have been, from an up-country business, etc. It's difficult to reach Delhi. So there's been disruptions, right? So once some of these things happen, we should automatically improve. But to what extent and so on, I'm again going to stay away from. Again, this is all directional, right?
Okay, but it should directionally be northwards, both for this quarter as well as next year.
Absolutely.
Yeah, I mean, I think we did mention there are some transient cost saving also, which is there in this quarter. So I think obviously those will get corrected by end of December. We now put them in. So there'll be some incremental cost coming on that side. But yes, directionally we're saying that we'll be able to sustain these kind of margins plus minus 100 basis points here and there type.
But this is sort of marginal, but yeah.
Earlier you all had said that ROC of 20% plus achievable in medium term, and medium to long term your aspiration is for 25% plus. So these targets are now well within your radar, means well within achievable limits, which you think.
I think we may have already exceeded that. Now, if you annualize this quarter's performance.
Yes, that's what I said. These are well achievable of 25% also, giving to the commentary and the numbers you reported.
Already currently इसको analyze करके देख लो.
24.6%. Yeah.
Fair enough.
Okay, all the very best.
Thank you so much.
Thank you. The next question is from the line of Bharat Seth from Quest Investments. Please go ahead.
Hi sir, congratulations on good set of numbers. Sir, when we are talking of this merger and acquisition, any geographic mix change is likely to happen? I mean, when you say metro, so currently we have largely in NCR region, so other metro, and then if at all we go, how we really tie up with the doctors, which is a major, driver for our business.
I think we have a brand. Delhi, NCR, and Mumbai are clear cities where we have large presence. Other than that, Uttar Pradesh, Dehradun, we have presence in Punjab, both in Mohali and Bathinda, we have presence. Other than this, we will be seeking other metros, but as we sizable enough assets. We have the benefit now of being outperforming the rest of the players on most metrics, including growth and ARPOB and earnings for doctors. So I think that is something that would be helpful and would help us in being able to attract the best-in-class doctors as we have throughout our hospital portfolio.
Okay. And sir, after completing this brownfield expansion, do we have further, room for brownfield expansion?
Oh yes, we have 7.5 acres of land in Delhi. So in the first phase, we are bringing about 350 new beds, but we can expand it by additional 650 beds in Delhi. So we are making a basement and superstructure of 650 beds. We can take the capacity up to 900 beds. What we are launching upfront are 350 beds. This is in Delhi. In Bombay, we can create 500 beds. What we are launching first is a 152 bed capacity, and the balance will happen in the second phase. So we got quite a bit of elbow room.
And what is our strategy for this medical center and diagnostic business?
So we have a pathology business which has been growing at a very, very good clip, including during the COVID system. And, we intend to build retail on this. We are a dominant brand in Delhi NCR. So entry barriers for us are not very large, because we are aspirational business brand as far as doctors and patients both are concerned. So pathology is clearly something that we want to dig deeper into, and we want to build this out. So that is what we intending to do going forward. We won't be building retail.
So mainly it will be focusing Delhi and NCR region?
To start with.
Okay, and medical center?
Medical centers, we aren't really running any medical centers, so to say. You mean
international center?
International centers or?
What we have 4, medical center in Delhi and Panchil Park and...
Panchil, the daycare centers.
Yeah. I don't think
we are not going to be furthering on this. Yeah. We're not going to be rolling out any medical centers.
Okay. Thank you very much, sir.
We've actually shut 2.
Yeah, okay. One in this year, one last year.
One this year, one last year.
Okay. Thank you very much, sir.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Ankur Chadda, an individual investor. Please go ahead.
Hi. My question is with regards to the difference in the reported financial and the press release is missed the presentation. Can you please explain why there is a difference in the total income and tax?
I think you should. You would, if you see the presentation, you will find that there are some partner healthcare facilities that we have, which we cannot consolidate under 103 because of the technical reasons. Because these are there.
So next year you will be consolidating it, right?
Yes, they are there in the results. They are there in the presentation, but not in the.
Yeah, fine, I got it. Okay, so my next question is really about the growth prospects of Max Healthcare. Look, you stated clearly that you want to repay back your debt, and then you have about 1,400 odd beds in Mumbai and Delhi that you want to bring on as brownfield expansion. So what I see is like going ahead 3-4 years from now, you'll be generating a substantial amount of cash flow. And let's say you'll be generating about 800 to 1,000 crores of cash flow. That means you need to add about 800 to 1,000 beds, 1 crore a bed, I don't know, if 1 crore or 2 crores, maybe 500 beds every year. So what's your strategy to do that? You mentioned M&A, but do you have enough pipeline of M&A to be adding this huge amount of bed capacity to keep the growth momentum 3-5 years from now?
So I think first and foremost, we are already generating on a current run rate on an annualized basis about 500 odd crores of free cash flows.
Okay.
What we are using this money for, even in the last 2 quarters, if you see, consistently for paying down internal debt, consistently. Our total debt at the beginning of the year was 2,160 crores. It's come down to about 1,860 crores. And this is entirely through internal accruals. At present run rate, our debt to EBITDA is lower than 2. So it's quite comfortable from that standpoint. In fact, we prepaid amortization of debt over the next 2 years. We have 2.5 years prepaid that.
Sorry. Can I think I probably haven't explained my question very well. I'm fully happy with your capital structure and your debt position and your cash flows now. My real question is, once you pay back your existing debt, if you want to, let's say, be net debt free, if you paid back your debt, you've added the 1,400 bed brownfield capacity. What do you do after that? How do you grow? You mentioned M&A, but how many M&As can you have? Because what I see is you would need like at least 500 to 1,000 bed addition every year to sustain the growth momentum.
No, not really. I mean, the point I was trying to make is I'm not going to wait to become net debt free. Nobody will become net debt free. I'm quite comfortable, so I'm already ready to do what you're saying. It's not 3 to 4 years down the line. It is where we are today, right, as a starting point. So that's one. Secondly, once my expansion starts, I'm going to be incurring, let's say, 13 to 1,400 crores over the next 4 years. That's, let's say, about 300 odd crores. Even at present, if I'm generating cash, I'm generating about 200 plus crores extra per year, 250 crores of this thing. Now, in the Indian healthcare sector, I mean, if I'm looking at assets which are even circa, let's say, 500 beds, a single asset will not cost me less than 700 to 1,000 crores. Right? It's not as if I'm buying 100 crore assets or 200 crore assets. So one asset or two assets is something that we will be able to support. Having said all of this, you also have to understand my own, perhaps trajectory over the last 10 years. The track record has been, we've grown through M&A. From 1 to we went to 2, from 2 we went to 17. If we've done that over the last 10 years, there's no reason. This is something we are very, very comfortable with. Doing M&A.
And that's good. But is there enough pipeline? Is there enough such, let's say, hospital 500, 300, 400 bed hospitals in, let's say, Delhi NCR in Mumbai? Are there enough of those assets that you can potentially acquire? I mean, because what I see is you'll need at least 1 or 2 deals every year. Is there enough out there to be acquired?
Look, there's always enough and there's never enough. Okay, from a standpoint, it has to be available also. Of course, there are enough, but as and when there's a dislocation in the market, they become available. We have a pipeline. We are talking to people. These are typically preliminary stage conversations. If this was any more, then we would have been declaring it to the exchange. But as and when, I believe there will be certainly transactions over the next year or two, and we don't need to do 1 or 2 transactions a year. Like I said, 1,000 crores this thing per year, even on a 1-to-1 debt EBITDA, is all we can actually with the cash flows that we're generating.
Okay, that's good. So now you mentioned in your last con call, there was a passing remark about REIT, like you're getting involved with players who can build out the asset as per your spec, and then you can operate those. Is there any, because that to me seems like a much better way of doing things, because you, first of all, you create assets which are good for the country. And also, I mean, you get to just do the O&M and all of that, so you still keep up with your rate of returns, right? And then there will be less competition out there because you just buy a piece of land and just construct a new asset. Is there any like kind of development or anything you're talking to people about that, or there's no progress on that?
So we continue talking. We have to develop structures. It's a template which we have to develop, and then we kind of this thing. There are obviously some direct and indirect tax, particularly GST implications and so on, which one has to take into account. Directionally, I can't agree with you more. I think it is a very, very good way, and you're able to defer both capital allocation. You have to make less of a capital allocation as well as the risk of construction, which is a big risk which you kind of defray off your plate. So directionally, it is something that we will continue to work on. And, like I said, beyond a certain point, if any conversation had gone, then we would be obligated to declare it to the exchange.
Okay, one final thing. I presume that you are also like in active discussions with the policymakers, the regulators. Well, there's no regulator for healthcare, but you're still like talking to people like NITI Aayog and all of those in the country to develop a proper structure for this kind of market, right?
That's right, including PPPs.
Including PPPs, yes. Okay, that's it from me. Thank you and all the best, and a great set of numbers this quarter.
Thank you so much. Thank you.
Thank you. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Yeah, just a quick follow-up question. Sir, the presentation says that revenue share of institutional patients is 23%. What would be the bed share of institutional patients in this quarter?
32%. It's come down to 32%.
It's come down. And is that COVID specific, this change in mix, or it's more structural that you were alluding to?
So it's a little bit of both. Clearly, also, like I said, directionally that's where we intend to go. And therefore, when for example, a certain amount of beds were allocated to COVID, we had lesser capacity in non-COVID, which was overflowing. We obviously kind of stayed away from the business. And we discontinued those empanelments in some specific hospitals of ours already.
Got it, sir. All right, thanks.
I mean, it's hard to put down exactly what was COVID or not, but clearly this has been due to our own internal policy actions.
Thank you. The next question is from the line of Rishi Raj Agarwal, an individual investor. Please go ahead.
Yeah, hi Abhay. Congratulations on the good set of numbers. Just one question on any thoughts or any discussions about paying out dividends later on, maybe next year or next to next year or something like that.
We have book losses, so I think we are unable to pay out any dividend immediately. We will come up with a policy as and when we are able to. Technically, we can't pay out a dividend right now.
Okay, thank you.
Thank you. The next question is from the line of Pawan Ahluwalia from Laburnum. Please go ahead.
Thanks very much. I've had two questions. First, when you look at the M&A pipeline, based on what you've said, you'll be looking at the major metros, and I presume looking to replicate the model of just taking well-located metro hospitals and moving them into your sort of super specialty network where you can, bring more cutting-edge treatments and earn sort of higher margins. Just curious to get your take as you look at the impact of COVID on standalone hospitals in metro areas. Are they feeling greater heat than the big chains? Are they feeling less heat? Is there any reason to think that the owners or controllers of these hospitals would be more likely to want to get into some sort of arrangement with a large chain in the next couple of years than they've been in the last couple of years, or do you not really see any sort of step change in that relationship? That's the first question. The second is in terms of your own bandwidth. So obviously you've run two hospitals very successfully and done a very successful M&A. At this point, you're running a much larger hospital network. There's a strong leg of organic growth that's coming up. There are a number of operational initiatives you have. And at the same time, you have a robust deal pipeline that takes a lot of your attention. What is your time spent on, and how much sort of managerial change, if necessary, has been brought about to make sure that some of this is effectively run with only high-level oversight and not hands-on involvement in your part?
It's a little difficult to answer your question, but look, it would have been more appropriate when I moved from 1 to 2 or 2 to 17. But going forward, I don't see that as a challenge. We've been running it, as you've seen from the numbers, quite successfully over the last 2 years. More importantly, navigating it through the pandemic, which was an extremely, extremely challenging time. And once you've done that, you pretty much believe you can face up to anything. So that's out there. That's the second thing. I wouldn't know how it would work with purely oversight, because I like what I do, so I am in the middle of it, and a little difficult to figure out how it would be otherwise, to be honest. So that's at a philosophical level. But I think other than that, I think it's not only the metros, but even proven cities, like I said, we would be looking at. There are other proven cities, non-metros. For example, some of them where we are, Dehradun, for example, or Chandigarh, Mohali, for example, which is extremely, remunerative and attractive and profitable assets that we operate over there. So there can be other cities as well, but have to be proven cities. What I'm going to stay away from are greenfields.
Okay.
But we have more than adequate bandwidth. I have no issues in terms of trying to be able to absorb more, be it a single hospital or a chain in M&A.
Okay. And the first question around, is there a change in the bargaining power dynamics of, say, well-established standalone hospitals versus, large, well-capitalized chains like yourself?
So what happens is the standalone hospitals, obviously, things are going to get more and more competitive. What they will suffer from, and they do suffer from, is the ability to attract the top-tier talent. Synergies in purchase and purchasing power, and just, from a marketing standpoint. So, it's only a matter of time. I think, they'll opt for consolidation. But other than that, then I go to, another level of hospitals, which are really the small nursing homes, which are 100 beds or 150 beds, etc. I think there's been, an uptick in those, in fact, into occupancy, because a lot of people right now are still shying away from going to large-scale hospitals in spite of the numbers that you see. Therefore, what you see is the OPD numbers, etc., not back to, and even, people in our families and stuff like that, they don't go to hospitals unless they really have to right now. Because, although confidence is back, it's not back to pre-COVID levels. People are still quite apprehensive about going to hospitals. Whilst going to smaller nursing homes and daycare, etc., people still have started, the bounce back over there has been a lot more than larger hospitals. But going forward, the large single hospitals, I think there will be opportunities. There are opportunities. I think the smaller nursing homes, etc., is not really our play. So, the interest levels over there are quite, from at least from our standpoint, is not there, even if it would be from theirs.
Got it. But I'm talking about really more the 300-bed hospital in Delhi, the 500-bed hospital in Delhi that's been around for 20, 30 years, has a strong local reputation. But is the trust that controls that hospital, or the person that controls or owns that hospital, is that guy more interested in the conversation today than they were?
No, 100%. I think, a lot of them have taken a lot of stress during the pandemic. Their balance sheets have, and so have the operations, etc. Absolutely.
Got it. Thank you.
Thank you. The next question is from the line of Gitika Gupta from First Voyager Advisors. Please go ahead.
Question on Nanavati. Wanted to check where are we in the transformation and what kind of margins would it be running at now?
Well, it's back to profitability, but obviously the profitability levels of Nanavati, etc., were lower than others. Like I said, this is largely to do, in the previous call, largely to do with the personnel cost over there, which is significantly higher. And we are looking forward to a VRS over there. And once we are able to successfully implement that, those numbers should be good. Come up to speed with the rest of our portfolio as well. That should give a further fillip to our overall EBITDA.
Yeah. So, if I look at your rest of the network hospitals, you are really operating at 20% plus kind of margin. So, would it be fair to say another 2-3 years it will take? Because it seems to be taking a longer time. So, just want to understand, is it like a 2-3 year trajectory path, or a longer one that you see out there?
No, not really. So, I agree and disagree because it's operating at 7 to 8% margin. The personnel cost over there is about 34% rather than 22-23%. Right? So if I kind of fix it with a VRS, and VRS is more a one-time or a two-time event. It's not something which drives over 3-4 years. It would have been or should have happened last year, but obviously you can't launch a VRS right in the middle of a pandemic. You may case have shortage of people and so on, as you may appreciate, right? Yeah. So we had to kind of put it off. I think we probably aim for the first quarter next year to be able to implement this. And once we rectify that this thing, I think immediately we'll have a 18 to 19% EBITDA margin. We should be able to get there. But now a VRS can happen in 2 installments. I've rarely heard of VRS happening in 3. But it shouldn't be a 2-year plan. I think it should be a year or so. But out of a portfolio of 15 odd hospitals, you are bound to have some delayed successes.
Yeah, got it. Okay, great, thanks.
My point being, it's not a 2-3 year play where we actually, it's got nothing to do with revenue, it's got nothing to do with operations, it's just that one line item which needs to be fixed.
Yeah, no, but you acquired Nanavati before Max, right? So from that perspective, I was coming from that, it's taken, that VRS, I understand it's a 1 or 2 event thing, but still it seems to have taken a much longer time. So
if you actually see Nanavati, we got in FY15, and Nanavati was at that time burning 5 crores a month, 12,000 ARPOB and 9 crores of sales. So in 4 years, we moved from there to 27 crores positive EBITDA, 12,000 ARPOB moved to 48,000, and 9 crores of sales a month moved to about 33 crores. So it's been a journey, right? So it's not. You have to compare it not even to a green field. You have to compare it to something which is below water at that point of time, right?
Yeah.
So if I run a green field, then I would be pretty much here where I am right now with Nanavati.
Okay. Yeah, that's it. Thanks. Yeah.
And the advantage in Nanavati was the 5 acres of land also. So I think, there are some attractive qualities.
Okay.
Please. Sorry.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to the management for the closing comments.
So thank you for making the time and being on this call. I look forward to further interactions, and over the next quarter as well. Thank you so much.
Thank you. Ladies and gentlemen, on behalf of Max Healthcare Institute Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.